You know, it's a question we all ask ourselves at some point. Okay, I've got a little bit of money saved up. What do I actually do with it? Well, in this explainer, we're going to take that very simple question and turn it into a powerful, long-term strategy for building real wealth. Let's get right into it.
So let's imagine this scenario. A nice, clean $10,000 hits your bank account. Maybe it's a tax refund, a bonus, whatever. The first thought is obvious. How can I make this money make more money? And right away, two popular choices usually come to mind: a high-yield savings account or a money market account. So, which one's the real winner here?
All right, let's look at the hard numbers. You drop that $10,000 into a high-yield savings account with a 4.20% rate. After 9 months, you've earned about $313. Not bad. The money market account at 4.10% gets you just over $305. So the high-yield savings account wins. Case closed, right? Well, not so fast.
The huge, life-changing difference between those two options over 9 months is $7.42. Yeah, that's barely enough to grab a coffee. And this is the exact moment when you should realize we might be asking the completely wrong question.
See, here's the thing. Obsessing over these tiny little percentage points for short-term gains, it's really just a distraction. The real secret, the actual, powerful engine that can turn that $10,000 into something seriously substantial over time, is something else entirely.
And that engine is the magic of compounding. It is, without a doubt, one of the most powerful forces in all of finance, and it works quietly, almost invisibly, in the background. So let's break down exactly what this is.
Okay, so what does that actually mean? Put simply, compounding is your money making money. And then all that new money starts making its own money. It's like a snowball rolling downhill. It starts small, but the longer it rolls, the bigger and faster it gets. This is the absolute foundation of building wealth long-term. Let's actually visualize this. So you invest that $10,000 and get a pretty average 6% annual return. After 1 year, you've made $600. That's a nice start for sure, but it doesn't exactly feel like magic just yet, does it? The growth is, well, it's pretty modest.
But now, let's jump forward 10 years. You haven't added another dime to that initial investment, but now it's worth almost $18,000. Now you can see it, right? The growth is actually starting to accelerate. Your money is starting to do more and more of the heavy lifting all by itself.
But now, look at this. This is where the magic really happens. After 30 years, your initial 10 grand has absolutely exploded to nearly $57,500. That gigantic leap in the later years, that is the power of compounding in its full glory. It proves it's not about timing the market, it's about time in the market.
Okay, so we understand the engine, compounding, but how do we actually steer it? I mean, your financial goals at 25 are totally different than they are at 55. We need a map for this journey, and that map is often called the wealth cycle.
And here it is. This is basically the roadmap for your entire financial life. You can see it's a clear progression. You start by creating wealth, then you really focus on growing it, and finally you shift your focus to preserving that wealth and figuring out how you want to distribute it. Let's break this down by age.
So in your 20s, it is all about building a super strong foundation. That means getting a budget in place. Something simple like the 50-30-20 rule works great. It's also absolutely critical to build an emergency fund. And of course, you want to manage any debt you have, like student loans, and start making small, consistent retirement contributions. Even tiny amounts at this stage have decades to grow.
Now, let's move into your 30s and 40s. For a lot of us, these are our peak earning years, so the name of the game shifts to accumulation and growth. You'll want to beef up that emergency fund, start making some serious progress on big goals like a house or saving for college, and really focus on smart, diversified investing. This is also the time to pay attention to taxes and make sure you're using tax-advantaged accounts.
And then, from your mid-40s on up, the focus shifts again. It becomes less about aggressive growth and more about protecting what you've already built. You'll probably start to take a little less risk in your portfolio. You can also use catch-up contributions to really max out those retirement accounts. And this is when you start thinking seriously about how you'll draw that money down in retirement and the kind of legacy you want to leave.
So we have the engine, compounding, and we have the map, the wealth cycle. Now we just need the vehicle to get us there. And the best news is you really don't need a PhD in finance to get started. There's some incredibly simple and powerful tools out there for everyone.
All right, let's talk strategy for a second. You'll hear about two main approaches, active and passive investing.
Active is when some fund manager is trying to be a hero, picking stocks, trying to beat the market. Sounds great, but it has high fees, and the vast majority of them actually fail to beat the market over the long run. Passive investing is way simpler, and for most people, way more effective. You're not trying to beat the market, you're just trying to be the market by buying a slice of everything through something like an index fund. The fees are super low, and you get the market's return.
So here's your simple toolkit. Index funds or ETFs are your workhorse. They give you instant diversification for just pennies. Then you've got target date funds, which are the ultimate set-it-and-forget-it option. You just pick your retirement year, and the fund does all the work, getting more conservative as you get older. And then there are robo-advisors, which use smart technology to build a portfolio for you. All three are fantastic, low-effort ways to get started.
Now, a crucial tool you need to know about is the IRA, or Individual Retirement Account. And the big choice here is between a traditional and a Roth. Think of it like this. Do you want to pay taxes now, or do you want to pay them later? With a traditional IRA, you might get a tax break now, but you'll pay taxes on your withdrawals when you retire. With a Roth IRA, it's the opposite. You pay the taxes today, but then all of your qualified withdrawals in retirement are 100% tax-free. For a lot of younger people who expect to be in a higher tax bracket later in life, that Roth is an incredibly powerful tool.
Okay, we have covered a ton of ground. We've talked about the what, the when, and the how. We started with a simple question about $10,000 and ended up with a strategy for your entire life. So now let's pull it all together into a clear plan you can literally start today. It really just boils down to these 3 simple steps. Number 1, automate it. Make your investing happen without you even having to think about it. Number 2, keep your costs as low as humanly possible. Use those low-cost index funds we talked about, because every dollar you pay in fees is a dollar that isn't growing for you. And number 3, be patient. This is a marathon, not a sprint. Your biggest superpower is time, so let that compounding engine do its thing.
And that's what it all comes down to, really. The single biggest factor in your success isn't picking the perfect stock. It's just starting. Whether that's opening that first IRA, setting up a tiny automatic transfer, or just bumping up your 401k contribution by 1%. The best time to do it was yesterday. But the second best time is right now. So your future self is watching. What one move are you going to make today?